Welcome, everyone, to the next OXBC podcast. And we're very glad today to welcome Anatoly Crachilov. He is founding partner and CEO of Nickel Digital Asset Management. I know that you're launching two more funds, and we want to hear what your first fund is focused on, and then the funds 2 and 3. If you can break down for us, what would your typical institutional investors say are the reasons for not going ahead, that you then have to demonstrate, actually, we've solved problem 1, we've solved problem 2, we've solved problem 3. What are the key problems?
Correct. So I think the interest is there, and it's well demonstrated by the recent review by Fidelity. And Fidelity essentially went to most of their clients, or kind of large scale institutional clients. I think it was 411 of them, and ask a very simple question. Would you guys, do you see place for digital assets in your portfolio? And guess what? Nearly 50% said, yes, we do see the place for crypto in our portfolios. And this is amazing. If you look on the market, we're talking about billions and trillions of dollars, which are potentially exploring this market. Now, back to your question as to what prevents institutional investors from taking an exposure whilst the understanding is already there. And essentially, this is the whole setup, the logistics of this, if you will, kind of a process. How do you access the market? And all these hacks which happen on various exchanges do not help. And if you think the underlying protocol, say Bitcoin or Ethereum, was never hacked, and Bitcoin has been around for 10 years, and it was never hacked. What was hacked? Various exchanges which hold your private key, right? And private key, given that all these transactions are irreversible, whoever holds the private key controls the asset. So key management is of paramount importance. Now, if you are an institutional investor, your first question, like, how do I deal with that? If I were to buy an asset, and you have to deal with various exchanges, some of them are regulated, some of them unregulated. But even if you has gone through everything and finally get hold of 20 million worth of Bitcoin, how do you hold it? And the custody issue has been around for a while. I believe we are kind of, the whole market generally has solved this problem by now. But if you look on the many institutional, or kind of many fund managers, they would use a thing which is called self-custody. What it implies that you would hold your private key either at the exchange, which is the riskiest form of holding private keys, because if exchange is compromised, so are your keys, and you just lost your $20-30 million. Now, the alternative is to have private key on your small device, right, which is called cold storage. But again, many managers would keep this cold storage in their safe. They would disconnect it from the internet, thus preventing external attacks, and they would connect it to the USB port for trading purposes and then disconnect again. But with all this set up, there is one thing called single point of failure. If that manager were, for whatever reason, disappear, and we've seen a number of examples of that, most recent being Quadriga Exchange in Canada, when the guy who was running the exchange disappeared somewhere in India, and guess what? You immediately lost the entire holding. So as an institutional investor, you cannot take this risk. Your fiduciary responsibility would not allow this to be part of your investment equation. So the way you approach that, you have to create a structure which to some extent resembles conventional world, when there is a prime brokerage and some third-party custodians. And that's exactly the way we went. I would even say we would not have launched the fund unless a solution was there in place. And today we use a London-based company which essentially designed an institutional quality custody solution. And the fundamental idea that I, as a manager, I have no control over investment funds. I can take investment decision, I can execute certain trades, but I cannot run away with the asset. Interestingly enough, if custodian were to go out of business for whatever reason, we're not taking a counterparty risk on custodian. We would still have investors' funds fully protected. How would we achieve that? That comes through what is called multi-sig. And multi-sig is very well-known concept. You would have some of the assets like Bitcoin. It has multi-sig inbuilt, multi-signature inbuilt on the protocol level, where say you have 2 out of 3 individuals have to sign on a particular transaction for that transaction to be broadcasted to the entire network. You can do 3 out of 4, 5 out of 6, 10 out of 20, whatever. You can choose kind of how many signatory you may wish to have. But fundamental idea is there is no one person who controls the entire asset. And that what institutional investors wanted to see implemented. So our solution, I believe, gave this comfort to institutional investors, and every single of our clients, of our investors who did due diligence on us, did due diligence on our custodian, and every single of them said, this is solution I'm comfortable with. What's more, we have 3 fund of funds as our investors, and one of them just realized that what they have today as a custody solution with their other investee funds was far weaker to what they discovered by analyzing our setup. So they are forcing their other investee funds to move to our custodian platform, not our, because it's independent from us. But basically, we're helping this market find this greater comfort, greater security. And by virtue of that, I believe, we're going to reopen the whole digital asset market to a larger volumes coming from institutional investors. That's the mission we are kind of seeing for ourselves.
Is that custody solution much more expensive than conventional custody in a normal traditional investment context?
The answer is yes. So normally custody would be 3-5 bips, maybe kind of coming down to 0, right? In digital assets, we started at 1% custody fee a couple of years ago. Now it comes down to something like 60 to 50 bips, still well above conventional custody. But hey, there is a great risk to be mitigated. So we believe it's justified at this stage. But we realize over time it's going to shrink and these spreads will come down. And we can see this market becomes more competitive because there are newcomers which are coming to the market and kind of offering custodial solutions. We would not compromise on cost. We would not compromise on security. And we are happy to pay slightly higher cost for the sake of getting the best solution out there. And I think what we have today is really kind of a prime solution. The company is called Copper Technology. They have been awarded by HFM, which is the hedge fund magazine, earlier this year, an award which is best digital custodian for hedge funds, which for us was like, that's an amazing kind of to see our custodian getting that sort of award, because we discovered this technology well before it was discovered by the whole hedge fund community. But at least we made the right choice. Kind of, it was now kind of confirmed by the wider vote, if you will, of confidence.
Good choices. That's good to hear. So a summary so far would be custody was a problem that you feel you guys have solved for institutional investors, and also just the pattern or style of investing, and that you've been able to demonstrate that you're taking, if you like, some traditional methodologies that other investors would have found in other funds they're comfortable with, and you're using those in your fund one. Would you say there are any other key problems, or shall we move on to funds 2 and 3 and you can tell us about them?
No, volatility is certainly something which kind of maybe a red flag for many. They would like to see this more sustainable path, or not sustainable, kind of less volatile path. For us, as a volatility arbitrageur, That's basically volatility is great. We would like the volatility kind of to stay there. We realize it's going to converge to something less extreme over time. But for many investors, that's still something they might be uncomfortable with. However, what we have offered as an arbitrage fund was exactly what they were looking for. Because essentially what we do, we convert extreme volatility in low volatility returns. And we're not promising the moon, because to make 5x, you need to take a proper long exposure to Bitcoin and other crypto assets. However, with us, you would target 10 to 15% annualized return, but in very predictable manner. And to give you an idea, we had 2 years of prior experience, specifically my partners, who were managing the same arbitrage strategies for 2 large family offices. One was French, and then later on a UK-based family office, and there was not a single down month. And that's the beauty of this strategy. If you're truly market neutral, you're not supposed to lose money if the market goes south, right? So you are supposed to make money in every market environment. And in 2017, when the market was rallying, and Michael and his team, they made positive returns, that was like fabulous. But really, the test was the following year, when 2018 market was collapsing and the whole market went down 85%. They made solid double digits positive return, which was a testimony that the strategy is truly market neutral. And that was of appeal to many institutional investors who came to become our founding investors. They were really looking for these kind of uncorrelated returns. Now,
with the last 6 months, you've been going 6 months with Fund One?
Correct. So we launched in June with the intention to raise 50 million. Why is 50? Because as any arbitrage strategy, there is a limitation how much money you can manage. It's what is called limited capacity strategy. And what is limited by, essentially by the depth of underlying market. You cannot throw $1 billion in arbitrage strategy in crypto market. You just cannot process that sort of volumes. As a matter of fact, by raising 50 million, we became one of the 3 largest ARB funds in the world, which comes as a surprise because it's relatively small amount of money. But yet for this space, it's already somewhere kind of at the top limit how much market can process. So the other 2 funds are based in San Francisco and New York. And we happen to be the only European fund managing 50 million in ARB space. Can we go beyond 50? The answer is yes. And it's really, there is a correlation with the depth, as I mentioned, of the market. As crypto market expands and say doubles in size, our strategy will expand as well. The capacity will expand. It's not a linear dependency. Say if market doubles, our strategy goes up by perhaps 40% as the capacity. But that's why when we launched, we were humbled by the demand for this strategy, specifically from institutions which came from those institutions who already have exposure to crypto market, and they realized that our strategy has a limited capacity. So they would come and negotiate how much they would take. And we had a negotiation, people were demanding 20 million allocation. And I was like, I cannot give you 20 million because out of 50, we need to create some diversification of investor base, not to have this unwanted dependency on one large client. So ultimately we scaled this down, but we saw this demand, and 50 million essentially was raised in the first less than 3 months. Now we're going to reopen at some stage as the market evolves and greater trading activity emerges in digital assets market. And we have already kind of a queue of investors who are kind of on the waiting list, which is a great position to be in, right?
That's a good problem to have.
Exactly. That's good
so as we sort of come into land, tell us a little bit about the fact that you've been authorized by the FCA for 2 new funds, and are these going to have a different strategy? What's coming up?
Exactly. So if you think in arbitrage, capacity is limited. It may be from 50 to 100, maybe 150, but that's perhaps the maximum. But what we realized, there was a demand coming from our existing investors who were seeking access to the market on a broader scale. And as I said, in arbitrage, you will not make 5x. But they were looking to gain some meaningful exposure, say 1 to 3% of their overall portfolio to Bitcoin and Ethereum. And the question was like, can you help us buy this asset? And my initial reaction was like, hey guys, it's just open an account on Coinbase and buy the stuff. Kind of, why do we need, there is no really management skills per se to be used in buying and holding an asset. And they were like, listen, don't tell, it's not that easy. You need to open accounts, which is kind of the simplest thing. But then by virtue of deploying 10, 20 million, you are moving market. And that's true. If you look on even Coinbase today, and we tested it on multiple occasions, if you go in one go 10 million, the slippage, which is the deviation from current spot price to something what is called now execution price, because you are going in the order book and you pick up every single sell order in order to kind of satisfy your 10 million ticket. And you may move market easily by 300 basis points. So 3% by virtue of you deploying 10 to 15 million, that's a significant move, right? So you don't want to move the market against you by these large volumes. That's the first problem. And then even when you buy the asset, you still have this logistic kind of the infrastructure issue. How do you hold this thing? How do you manage the key? Now that you have a significant exposure, you need this triple layer of protection to hold this asset. And people are not willing to speculate in this particular case. They're willing to take a long-term view, which can be as long as 3 years, 5 years. But still, you need to ensure your asset is custodied in a manner which kind of nearly eliminates the risk of you losing the assets meanwhile, right? So again, it comes to key management. And people were like, hey guys, you have all the infrastructure. Why don't you offer this as a service? And I thought like, well, listen, this is a ETF-like product, right? It should really, how much can I charge for that? Perhaps if you look ETF on S&P, it's literally 7 bips, right? ETF on emerging market equity would be 25 bips, maybe 50. But this is the maximum. And then what we were pointed out to existing alternatives. And specifically in the US, you would have few large providers of that service. For example, there are a very famous company called Grayscale. So what they do, essentially, they offer you a trust. You would invest in the trust, and that trust would hold one asset only, Bitcoin. So essentially, you are gaining an exposure to Bitcoin. Now, question, what are the terms and conditions? The answer is, these guys are charging 2% management fee, which is ridiculous. There is no management per se, right? It's just kind of holding an asset. Moreover, they're demanding 1 year lockup, which is, wait a minute, the underlying asset is completely liquid. Why would you demand 1 year lockup? And apparently there is some regulatory requirements or something about that. And then once you are off your lockup, there is no redemption program. You cannot bring the assets back to them saying like, hey, I would like to redeem my shares in the fund or a trust against cash. There's like, no. Go to the secondary market and sell it on the secondary market. And that market can trade either at premium, as it does now, but can trade at a discount to what is the fair value, say 1 Bitcoin, right? And question like, who in the right mind would give them money under management? And guess what? These guys are managing $2 billion. And last quarter was the most successful quarter in their history in fundraising for that fund. And I was like, wait a minute. I always thought that the whole crypto market or blockchain industry was meant to disrupt conventional traditional finance. But I can see that we can disrupt other crypto players in this market because of the efficiencies which got built in this system. And fair enough, these guys have been around for 6 years. Maybe 6 years ago, charging 2% was more than fair. But in today's market, I believe it's not fair. So my solution was, okay, instead of charging 2%, we're going to be charging 25 bips, 8 times lower. Instead of making a year lockup, it's going to be daily liquidity. Instead of no redemption program, it's going to be redemption at NAV, no premiums, no discounts, fair value. And basically, by virtue of that, you are allowing a broader institutional investor to say like, hey, now access to the market is A, transparent, B, cost efficient. And if on top of that, you offer custody solution, which as we discovered, they see as adequate and well protecting their holding, that's how you allow the market to open, right? And that's how you create this flood of fiat into digital assets market. And that's what I want to see. I want to us be kind of a facilitator for institutional investors to get them easy and transparent access to the market. And of course, that's going to help the whole industry to develop, right? It's going to help price action. It's going to have perhaps a positive effect on Bitcoin, although this is not my stated goal. But of course, I would like to see more institutional investors coming this way. And we see this pending demand, because even in this office, we had a few very large institutional investors who came to see us. Without naming them, we're talking about hundreds of $billions under management. And these guys are coming with, the opening line was like, hey, as a disclaimer, we're not yet here to write a check. And my reaction was like, I would be surprised to see you guys writing a check, because really the way I see this market at this stage is primarily a game for family offices, high net worth individuals, rather than a large pension funds or insurance companies. And the person who came to see us, he was like, don't say that. Actually, we are looking closely at the market. And we had our initial review a year ago. We decided it was too early. We're still on this opinion, but they would like to talk to people who are deeply embedded in the market to take an informative decision where the market is and whether it becomes investable or not. So we spent 2 hours running through arbitrage fund, techniques we deploy, and the whole toolbox we have in our disposal. And his reaction was like, stay where you are. I'm bringing my due diligence team. And I was like, wow, that was a very fast conversion. I didn't expect that to happen. And internally, I think like for them, it's going to take a year, 2 years perhaps to make a decision just because of their size and complexity of decision making. But the mere fact that they are looking closely and exploring, I was like, listen, I don't expect immediate business, but I'm happy to invest my time and help you guys understanding the market. I realize we're deeply embedded. We perhaps see this market from various angles, and we are happy to educate you and help you gain confidence in this market. And whenever you're ready, a year from now, 2 years, we're going to give you the platform to access the market. If you want to be market neutral, they're going to be arbitrage fund. If you are prepared to be more adventurous, take a long exposure, they're going to be what we call gold, digital gold fund, right? Which is Bitcoin only. Or the third fund, which we're going to be launching, is called Digital Leaders. And logic here, fundamental, is as follows. If you look on today's crypto market, you have one massive asset which leads the pack, right? Bitcoin, essentially 70% market dominance. And then you have few other assets. And say if you look at the top 10, what's the probability all these top 10 will remain there 5 years from now? And I can bet that this top 10 league table going to be massively reshuffled over the next 5 years. Bitcoin may still be there, and I'm not Bitcoin maximalist. As a matter of fact, I have some reservations to this technology, and yet acknowledge there is a network effect which is likely to keep it alive, be in the top position on, or at least top 5, top 10. But many others gonna get reshuffled, and market gonna change dramatically. So if you are an investor, and a good historical reference would be, let's look at 2007, mobile phone market. Nokia is an undisputable leader in this market, controlling 53% of all new handset supply are coming from Nokia. Then you have Ericsson, some smaller players, Motorola, LG, or whatever. Then you look 5 years down the road, 2012. Nokia is supplying 3%, down from 53. 3% of the new phone, completely destroyed. Some companies which were unheard of. Apple, what Apple has to do with mobile phones? Or Samsung, which is kind of, what Samsung has to do with mobile phones? Suddenly displaced completely Nokia. So if your grandmom gave you this as part of her will, Nokia shares, and you would lock these Nokia shares in the safe box, saying like, this is my future. You open this box 5 years from down the road, and these shares were nothing, just because the leader got displaced. So coming back to crypto market, what I would like to deliver as a very simple product would be as follows. We are buying top leaders today, say top 10, and we are rebalancing on your behalf, Mr. Investor, over the next 5 years on a weekly basis, on monthly basis, it depends how market evolves. But one thing you should rest assured, 5 years from now, you will still own top 10 position in crypto market, whoever they are. Your only bet is, will crypto market still be there? And if you share our view that this industry is there to stay and will evolve, you will own market leaders. Is it a complex product? No, it's algo driven. You look on the weightings of individual assets in the digital asset market. You should be very careful not to pick up those kind of what's called pump and dump schemes when an asset from nowhere enters top 10, and you should be careful not to buy it because you may kind of end up losing value because it just collapses down to below 10. So we are putting some smart analytical features around that. But generally, the idea is kind of buy top 10 and you will be exposed to the top 10 3 years from now, 5 years from now. And the cost of this product should be 50, 75 basis points. So from the investor perspective, I don't have to deal with all this complexity of analyzing. If you can do it for me for 50 bips, be my guest. I'm happy to give you a capital. So that's another product which allows access to the market in a very transparent and cost-efficient manner. For those investors who are willing to take a view, 5 years view, right? And yet the whole product going to be completely liquid. You can exit at any day because it's going to be daily liquidity. And we would recommend kind of taking a longer view rather than daily. But we're going to help you kind of rebalance the portfolio for the benefit of your exposure to the market.
And with no performance fee on that. That's just a management fee.
That's going to be just a management fee. We're going to impose a fee which is called crystallization fee, which is roughly going to be 75 bips to 1%. And where it is, we would like to prevent aggressive trading on these funds. So essentially, if you take a long-term view and your position tripled, you made 200%, would you care about 1%? You wouldn't, right? Kind of, you are happy on the exit to pay 1%. However, what I don't want to see is a short-term players who are taking view on the fund and just because it's daily liquidity would sell it in 3 days, then buy it again, sell it again. We're not really there serving this market. We're really catering for institutional investors willing to take a longer term view. And this crystallization fee would perhaps prevent this unnecessary trading within the fund, within kind of this speculation trading.
So maybe a natural question looking ahead from that is, do you get asked about the tokenization of a fund like that in the future, and whether that's something you've discussed with the FCA? Obviously, there's regulatory challenges around that, but what's your view on that? Appetite for it? Timescales?
Yeah, I'm a big fan of tokenization of assets in general, and I partially see as additional avenue for arbitrage fund to make money as the more and more assets are getting tokenized, because for us it's going to be various asset trading on various exchanges, various venues, and perhaps the price will not be synchronized ideally, so we can take some bets there. Now, coming back to tokenization of funds, the history knows there are a few funds which have been tokenized pretty successfully. We would like to be a pioneer in this space as well and have one of our funds tokenized. What prevents me from going this way at this stage is as follows. Tokenization of funds would work better for retail investors who are willing to take exposure with $100, maybe $10,000. However, our minimum entry ticket is 1 million. For these investors, tokenization would create an extra layer of complexity, perhaps, and would not add much value. And kind of my investors are known to me one by one, rather than kind of there are 100,000 investors around the world whom I have no idea who they are, but by virtue of distributing my fund in a tokenized form, I'm accessing this market. I'm not willing to go this way at this stage. So my agreement with FCA, we are serving professional market only with certain minimum thresholds. And by virtue of that, we are not selling to a broader public, right? So tokenization would not help me at this stage. However, as we develop and maybe some products will become kind of more suitable for retail investors. And then these we will go to FCA to explore this opportunity. And I would love to be kind of the first to bring this to the market in hedge fund world, if I can. But certainly arbitrage is it too complex of a strategy to be a retail strategy, right?
But your digital leaders fund, your top 10.
You're right. Digital leaders can be a perfect candidate. It could be a perfect candidate for that, right? Because by buying one token, you're getting exposure to 10 underlying, and you know there is some thinking behind, and you know there is going to be rebalance on your behalf. So there is some logic to that, some value added. I don't think I would kind of aggressively push this through FCA at this stage, but we will certainly revert to that later on when the fund takes off and there are going to be already some institutional players. Then we may just lower this minimum threshold down to more retail levels, but it would require much wider communication with FCA.
Any final questions?
Yeah, I think you've given us a great insight, Anatoly, especially solving the institutional access with your custody solution. That's a great thing for the whole market, making them more comfortable, which is the big goal for everyone.
Yeah, I think it's for benefit of the entire market, entire digital asset space. And if we can contribute to that and help the market evolve, I think our mission to some extent will be accomplished, right?
Well done. It's amazing. So you launched this final question then. You launched in June, and so assets under management now is 50. So what do you think your assets under management will be by the end of June 2020, when you've got your two new funds up?
Well, we'll need to test it with institutional clients. What's their decision making, right? Because I can see demand coming from our existing few clients. So we should be able to have, I don't know, 50 additional million, perhaps relatively easy. Going for the larger amounts, and I think this fund can be $1 billion, $2 billion large fund with the horizon 3 to 5 years. By June next year, I think I will be largely involved in educational journey with many institutional clients, but hopefully providing the infrastructure which are comfortable to them will speed up their decision making and allocation ultimately. So I wouldn't commit to any specific number by July next year, but I would hope us to double and triple in the next year or so. Sure.
Excellent. Well, look, thanks so much for taking the time. Fabulous to hear about the journey, and great to see that Nicholas, has taken off its nappies and is walking, and maybe will be beginning to jog next year. So that's great stuff. So we wish you good luck, and look forward maybe to catching up with you again when we see what's happened with your two funds sometime next year.
Absolutely, with great pleasure.
All right.
Many thanks, guys, for this time. It was really a pleasure talking to you.
Great. Thank you.
All right. Goodbye.